Historically speaking, the Fed doesn't cut rates in anticipation of an economic downturn in order to prevent it. Policy change on interest rates usually happens when new labor market data comes in from the BLS and the damage to the labor market has already been done. Easing rates into economic strength can cause an economic boom, while cutting rates into economic weakness can cause each layer of the credit cycle to become exposed. And policy change isn't just a one-off for the job market, it's a chain reaction between corporate debt, pension funds, cities, and households. So let's discuss these four categories and determine how a cutting cycle into economic weakness would affect each of these sectors' credit. Corporate debt and credit are your first default line because quarterly earnings are what determines where the S&P moves on a day-to-day basis. Corporations that issued 10-year maturity debt in between 2011 and 2015 are now refinancing at rates that are 2 to 3 times higher. Additionally, corporations that finance debt with a 5-year maturity at the COVID low also have to refinance 3 to 4 times higher, being that the federal funds rate is consistent at 4%. In any economic downturn where there is less liquidity in the system and lower rates to promote borrowing, corporate earnings will move downward, the money flow will slow, and debt will need to be serviced. And as quarterly earnings shrink, you can expect credit spreads to widen, making it even harder for corporations to borrow and expand on their quarterly revenue. Next up, municipalities. Cities like New York rely on property tax-backed bonds in order to fund the construction of new schools, roads, and infrastructure. And if the economy is weakening, so will the value of that city's property. The problem is the debt that they issued for all that construction is fixed. So that revenue to pay off that debt has to come from somewhere. And if you see what Mamdani is doing right now in New York, he's going to raise property taxes potentially 9.5% on the middle class to do so. And this can cause a chain reaction for citizens to leave that city, lowering production in the labor market and GDP as a whole, which in turn will lead to lower demand for property, causing them to lose value and collect less revenue over time. Third up is pension funds, some of the largest institutions domestically. Pension funds partner with corporate institutions and receive a percentage revenue based off their workers' salaries. But if there's less revenue coming in that is going to be paid out in pensions years down the road, then the model starts to break. During an economic downturn, pension funds use their investment wings to invest in high-yielding products in order to maintain any revenue being lost on the worker side. But this will only last so long because eventually those asset prices will continue to shrink in price as well, causing immediate debt to be serviced and a liquidation of those assets on their balance sheet. And the last and most important category to be squeezed are households. So let's review some of these debt stats. Retail credit card 90-day delinquencies at 12.7%, almost back to the 2008 high of 13.7%. Credit card charge-offs have quadrupled in the last 3 years, reaching a total of $1.3 trillion. Current 90-day student loan delinquency rates are 16.2%, the highest ever. And subprime 60-day auto loan delinquency rates have now reached a total of 6.9%. 4.8% of all outstanding household debt was in some stage of delinquency. And as you know, consumer spending is roughly 70% of GDP. So if the consumer dies, so does the economy.